Welcome back to the Pro Ticker Podcast, your Friday morning edition, covering major financial magazine headlines, everyone.
Good morning.
We have such a fascinating collection of source material today. I mean, we've pulled from Reuters, CNBC, and Bloomberg, and it all points to this market that's really struggling to reconcile two very different realities.
It's more than a struggle. It's a huge contradiction. You have this, explosive, almost irrational excitement that's just fueling the AI mega cap stocks.
Right.
And then on the other hand, you have investors showing, frankly, sharp skepticism about near-term profitability outside of just a handful of winners. And that's leading to a really profound investment rotation.
That is precisely our mission for this deep dive. We're going to explore that core tension. Is this explosive AI growth creating genuinely unstoppable giants? Or is the market already a little wary of those frothy valuations? Is it actively diversifying away from what some are calling the scrum of the tech sector?
Yeah, where do you even start?
Okay, let's unpack this. Let's start right at the heart of the tech frenzy.
We should. There's some critical commentary from the NTT data chief, which was reported by Reuters, and it really sets the scene perfectly.
Okay.
They suggest we might be approaching a normalization phase over the next 12 months, predicting that this current wave of AI excitement, what some people are calling a bubble,
Here we go.
it's going to deflate faster than past tech cycles.
Faster. See, that's interesting. If the long-term faith in AI is so high, why isn't the market just absorbing this cycle easily, like it has in the past?
Yeah.
Why is this normalization period supposed to be so uniquely fast?
I think it suggests that the excitement is it's outpacing the immediate ability to monetize that excitement.
Right.
But the key word here is normalization. It's not a collapse. NTT data is very clear. AI is a massive secular trend. It's expected to emerge from the cycle even stronger.
So this isn't a temporary fad.
No, not at all. This
No.
isn't like some of the dot-com startups. This is fundamental infrastructure. But the short-term pricing issue, that is driven entirely by immediate, tangible constraints. And that's scarcity in the supply chain.
And we are seeing that. We're
Yeah.
seeing immediate supply chain issues where demand for compute, especially for those high-end GPUs, still runs way ahead of what can actually be delivered.
The source material noted that supply chains are, and this is a quote, almost spoken for over the next 2 to 3 years.
That's a powerful statement. It's basically committed capacity.
And scarcity translates directly into pricing power. As the analysis points out, that power tilts massively toward the chip makers and the hyperscalers.
The ones with the big cloud platforms.
Exactly. Those are the companies whose stretched valuations reflect their immediate control over that scarce capacity. If you control the compute right now, you control the economy.
And when we talk about controlling the compute, we are really talking about
NVIDIA. It's all about NVIDIA.
the undisputed king. Yeah. We saw multiple headlines from CNBC detailing their, quote, luxury problem, which is essentially just this massive pile of cash they've built up.
The growth is just astonishing. At the end of October, NVIDIA was sitting on $60.6 billion in cash and short-term investments.
$60.6 billion.
That's up from $13.3 billion in January of 2023. I mean, it's just astronomical. And they've generated this cash while being on a massive investment spree.
Right. They're spending it as fast as they make it.
Yeah.
Billions in stakes in Nokia, Intel, Anthropic. And just this week, a $2 billion investment in Synopsys.
That's it.
But is that truly a luxury problem? Or is this massive cash position a necessity given what they're spending? Are they spending fast enough to stave off the threat that's emerging, not from tiny startups, but from their biggest customers?
And that's the real threat, the customization war. You have Google and Amazon, who are major NVIDIA buyers, and they are now developing custom chips.
The ASICs.
The ASICs, yes. Application-specific integrated circuits like Google's TPUs and Amazon's new Trainium 3. I mean, this is the definition of fierce internal competition. They're trying to cut out the middleman.
And the competitive angle is so clear. I saw Amazon publicly touting that their Trainium 3 chip can save customers up to 50% on AI training costs for their specific workloads. It all comes down to total cost of ownership.
And to clarify TCO for you, we aren't just talking about the sticker price of the chip. We are factoring in energy consumption, cooling requirements, long-term procurement,
The whole package.
the whole thing. And a customized ASIC built exactly for Google's or Amazon's internal needs should offer better performance per watt than NVIDIA's general-purpose GPU, at least according to a Bernstein analysis we looked at.
It's a compelling argument, but NVIDIA still holds the flexibility card, doesn't it?
Exactly, that's the trade-off. For these hyperscalers, it's flexibility. If their AI models or their applications change radically, they might need a whole new ASIC design, which is costly and takes a lot of time. So they still need and still buy NVIDIA's general-purpose chips for R&D.
But NVIDIA seems to be taking it seriously. I saw their public statement on X, asserting their chips are a generation ahead.
Yeah.
It feels like the fight is getting personal.
It is. So while NVIDIA is fighting its U.S. customers and investing billions in its ecosystem, this battle is also raging globally. It's turning that chip rivalry into a strategic geopolitical necessity.
Absolutely. The geopolitical dimension is huge. This week we saw some incredible IPO data out of China, covered by both CNBC and Bloomberg, surrounding a company called More Threads.
They're being called China's NVIDIA.
And their IPO debut in Shanghai was, well, explosive. Shares soared over 400% following a $1.13 billion listing.
That's the biggest first-day pop for a major IPO in mainland China since the 2019 market reforms. It says so much about the investor appetite for domestic tech.
And the oversubscription rate was insane. The retail portion of the offering was oversubscribed something like 2,750 times.
But here's the massive dichotomy that really illustrates the strategic nature of this. All this incredible market froth comes despite the company being deeply unprofitable. They reported a net loss of, 724 million yuan in the first 3 quarters.
And the valuation itself is jaw-dropping. We're talking about a company valued at 123 times its price-to-sales ratio.
Which, to put that into context, is significantly higher than most of its mature tech peers. That multiple, that 123 times PS, that is not an economic bet on current earnings. It is a pure bet on strategy and geopolitics.
It has to be.
Absolutely. The backdrop here is critical. The U.S. Commerce Department added More Threads to the Entity List in October 2023, which limits its access to key U.S. technologies. This IPO surge is the market betting that national support will overcome those hurdles.
It underscores that for Beijing, homegrown GPU manufacturing is just essential.
That's right. They're fostering rivals to step into the vacuum that U.S. restrictions created.
That's a perfect pivot point. Let's pull back from the hardware battle for a second and look at the actual human and enterprise implementation of AI. This is where the tension between that corporate excitement and the labor reality really surfaces in the Reuters coverage.
The long-term view is still consistent. The NTT data chief sees significant dislocation over a 5 to 25-year horizon as roles just fundamentally change. But the pressure facing executives right now is immediate.
We saw a startling anecdote from the CEO of an AI startup called Writer Inc. She reported that when she closes a customer, they immediately ask her, "Great, how soon can I whack 30% of my team?"
Wow.
I mean, that is the explicit, immediate corporate desire being discussed, treating AI not as an augmentation tool, but as a direct headcount replacement.
And that kind of fear, it contrasts so sharply with the actual labor market data.
Yeah.
We saw a recent PwC survey that said daily use of generative AI is still significantly lower than the executive hype suggests.
So most of the workforce isn't even using it yet.
Not really, but those who are using it are highly valuable. The wage premium for workers with proven AI skills is now commanding an average of 56% more than their peers.
That's more than double last year's figure. So the fear of job cuts is real. But at the same time, the price of necessary skills is just soaring because the supply isn't there.
And this is where the big enterprise software leaders step in to claim the value layer. They recognize that the underlying tech is rapidly commoditizing.
We saw Salesforce CEO Mark Benioff frame this when he was speaking to CNBC.
He did. He called the foundational technology, the large language models, the LLMs, he called them a commodity feature. His point was simple. We just want the lowest cost LLM, and then we plug it into our established systems.
The implication there is pretty profound. If the models themselves are commodities, then the huge valuations for companies focus purely on building general-purpose LLMs that could be seriously at risk.
Exactly. The true value, according to Benioff, lies in the proprietary customer data and what he called the killer apps, like their Agentforce product, that apply that commodity AI layer directly to enterprise workflows.
And it seems to be working for them. Agentforce hit $500 million in annualized revenue. It's growing at a massive 330% year over year.
And that's strong, tangible performance. It contrasts sharply with the sometimes volatile theoretical valuations we see in the pure play AI tech names.
Which leads us perfectly into the major investment rotation we mentioned at the top. The market is demanding tangible results, not just future potential.
Right. Jim Cramer, in his CNBC coverage, was very explicit about this volatility. He named Amazon, Salesforce, Meta, NVIDIA as part of this highly competitive zone. He called it the scrum of a sector.
And his advice was to pause putting new money there.
Instead, he suggests focusing on sectors that benefit directly from expected Fed rate cuts, the quote-unquote easy money sectors. These are the traditional, sometimes boring companies that tend to win big when borrowing costs go down.
So why do sectors like banks, transports, healthcare, and retail benefit so heavily from that?
Well, because they are so sensitive to financing costs and consumer confidence. I mean, think of transports like trucking companies. Lower interest rates mean lower financing costs for buying or leasing massive truck fleets.
And small-cap stocks.
Especially small caps, tracked by the Russell 2000. It's up more than twice any other major index this week. For them, lower rates alleviate debt burdens and make capital easier to get. We're seeing huge momentum in stocks like Saia and Heartland Express, trucking stocks with gains in the 15% range.
So this is capital fleeing that tech uncertainty.
It's heading straight towards sectors with clear interest rate-driven upside.
And we can tie this strategy directly back to the macro picture. Treasury yields are a little bit lower as the market waits for that delayed September PCE inflation data.
Yeah, and the University of Michigan Consumer Sentiment Survey, too. The consensus is heavily leaning toward easing. Traders are pricing in an 87% chance of a quarter-point rate cut next week at the December 10th FOMC meeting.
For our listeners, the FOMC is the Federal Open Market Committee, the Fed's policymaking body, and PCE is their preferred inflation gauge.
And the key is what the labor data tells the Fed.
Which is so mixed right now, reinforcing that need for caution. The Challenger report noted over 1 million job cuts for the year. That shows real corporate cost cutting.
But then you see weekly jobless claims hitting their lowest level since September of 2022. That suggests the hiring part of the market is still surprisingly resilient. It's this mixed picture that's providing the fuel for that rotation away from high-risk growth and into value.
Okay, moving beyond the U.S. borders, let's look at a pretty contradictory signal that came out of India, which CNBC covered.
The Reserve Bank of India cut its policy rate by 25 basis points to 5.25%. That matched the forecasts. But the rationale given by the governor was striking.
Yeah, he cited weakness in some key economic indicators, like industrial activity and PMI falling.
And this is where the contradiction deepens, because the economy just showed strong prior growth. It expanded 8.2% from July to September.
So why cut?
It seems driven in large part by external friction. The drag from U.S. tariffs, which put a 50% tariff on Indian goods back in August, caused exports to the U.S. to slide 8.5% in October. The RBI seems to be preemptively trying to support growth in the face of those global headwinds.
Speaking of global consumers, Bloomberg had a story on a potential revival for European luxury stocks heading into 2026. This feels like a classic cyclical recovery story.
It is. After a rough year for them, downturns in Q1 2025, because of tariffs and China concerns, analysts are projecting a return to 5% organic sales growth.
And this is mostly pinned on a rebound in Chinese spending.
Largely, yes. An expected 6% rebound in Chinese consumer spending in 2026, bouncing back from declines this year.
Analysts are already picking their favorites. I saw Richemont, the owner of Cartier, was a top pick. They've outperformed their peers this year. But this isn't a return to the stupid growth days, is it?
No, not according to the analysts. Growth won't get back to those double-digit percentage gains of the early 2020s. Demand from the aspirational consumer base, the ones most hit by inflation, is expected to stay muted.
So it's polarized.
Very. The very top-end customers are resilient, but the entry-level luxury consumer is still struggling. Brand segmentation is going to be critical for investors to watch.
All right, finally, a quick sweep of some major corporate stories, starting with a massive potential M&A deal. Bloomberg reported that Warner Bros. Discovery has entered exclusive talks to sell its film and TV studios and HBO Max to Netflix.
This is huge, and it signals a strategic shift for both companies. For Netflix, acquiring those legacy studios gives them massive control over valuable content. It could really reduce their future content creation costs.
And for WBD, it's a necessary move to slash its immense debt load.
Absolutely.
The eye-watering detail here, though, is Netflix's commitment. They offered a $5 billion breakup fee if regulators block the deal.
$5 billion. That is an enormous amount of money to put on the table. It signals extreme confidence that they can push this through regulatory hurdles, which are going to be intense.
No doubt. WBD stock rose on the news. Netflix dipped a little, which is common.
And briefly on infrastructure, there was a short-lived but widespread Cloudflare dashboard outage. It briefly impacted sites like LinkedIn and Coinbase before a fix was rolled out. It's just a perennial reminder of how much of the internet relies on a handful of centralized backbones.
And finally, crypto flows. Still volatile.
Very. Bloomberg reported BlackRock's IBIT Bitcoin ETF recorded its longest streak of weekly withdrawals since it debuted, shedding $2.7 billion over 5 weeks. But then it broke that streak on Thursday with a small but significant $60.6 million inflow. Institutional sentiment just swings wildly day to day.
So after exploring this whole AI battleground, the macroeconomic pivot, and all these global signals, what are the two most important takeaways you should be watching?
Okay, the first is simple. The long-term AI trend is certain, yes, but the short-term market is demanding active diversification away from that expensive, competitive tech core. Investors are hunting for tangible value and proof of monetization, not just future hype.
And the second point is that macro signals are now dictating asset allocation. The strong probability of Fed rate cuts, signs of an emerging global consumer revival, especially that luxury rebound in China. All of this is making traditionally boring sectors like transports and small caps incredibly attractive.
Right. It's capital rotating out of volatile tech.
The entire conversation today really shows a market that's demanding proof of sustainable profit.
It does. Whether it's a commodity AI model supporting a high-value platform like Salesforce's Agentforce, or a 400% IPO surge that happens despite losses simply because of geopolitical necessity. The crucial question going forward isn't if AI is valuable. It's where the market finds that real, sustainable profit when it's faced with such fierce competition and global friction.
And with that analysis of the major headlines, we'll see you all Monday morning with new headlines from major financial magazines.